All right, coming back to this where we left off. So once again, we were looking at the balance sheet method, right? We know this because when we take a look at our balance sheet, the balance sheet appears, has the accounts receivable and has the allowance for doubtful accounts. So in this case, right, when we talked about this, right, we need to look at three criteria. First criteria is going to be my estimated amount. So in this case, my estimated amount was $25,000 out of $500,000. So make sure in this case, I'm only looking at what my estimated amount is. Okay. Second thing I need to look out for is the word accounts receivable. In this case, yes, I do. I see the word account receivable. So therefore, the words that come after it, which is the balance in my allowance for doubtful accounts, I care about, okay? In this case, I have a debit balance of $5,000, right? If we look at how a balance scale works or a number line works, right? Right now, I am left, so in this case, I'm negative 5,000. How do I get to a positive 25,000? Okay? So in this case, right, in order to get to 0, that's 5,000. But I need to get to positive 25,000. So therefore, I need to add additional 25,000 to get to positive 25,000. Okay? So in this case, therefore, 5,000 plus my 25,000 is going to give me a total of 30,000. And that's exactly what I'm going to journalize here. I'm going to journalize because at the end of the day, my goal is I need to have a credit balance of $25,000 in my allowance for doubtful accounts. So in this case, my estimate is going to be my end goal. Okay? So because I currently have a debit balance and I care about it, I need to add those two numbers together to get 30,000, and that's what I'm going to journalize. I'm going to debit my bad debt expense because my expense is what I'm writing off. This is going to be my loss that I'm going to report to the IRS, is that I'm going to create a bad debt expense account, okay? And I'm taking it directly out from my allowance for doubtful accounts. Hence, this is why this is called the allowance methods, because I'm going to be taking it out from my allowance. Okay. So that's that example right there, right? We just covered that one. So let's talk about another example, except this time, right? Here's a different factor here, right? It is estimated that $25,000 out of my $500,000 accounts receivable is to be uncollectible. But there is currently a credit balance of $5,000, okay, in the allowance for doubtful accounts, okay? So coming back to the idea, right? If I already have $5,000 in my allowance for doubtful accounts and it's a credit balance, right? How many more do I need to get in order to get to my end goal of 25,000?
20,000.
Only 20,000. So in this idea, right, if you're using this method up here where I'm recognizing my estimated amount, I'm recognizing accounts receivable, and if I have a credit balance of $5,000, I'm going to take those two numbers, subtract them out to get 20,000. And that's exactly correct. I'm going to now journalize my allowance for doubtful accounts and my bad debt expense to be 20,000 because I'm already $5,000 on the right side. I need to get to a grand total 25,000 on the right side. So the difference between the two numbers is 20,000. Okay.
I'm a little lost. Okay, so you said how much are you said on the right side,
Mm-hmm.
which the right side you would subtract, and
So,
on the left side you would add. Balance in AFD A.
mm-hmm.
So on the debit you would add it, on the credit you would subtract it.
Correct. Okay, so it's okay.
Okay.
In this context, right? I'm
Mm-hmm.
already at positive 5,000. My end goal is I need to be positive 25,000. How many more do I need to get to 25,000 if I already am at 5,000?
Oh, 20,000.
Correct. Okay. Where the other given scenario was I was at negative 5,000 and I need to get to positive 25,000.
Positive.
Exactly.
Okay.
So if there's a debit balance, right? If you're on the left side already, you need to backtrack to get to the 0 point, and then you need to add an additional to however much to get to 25,000. So whatever your estimated amount is going to be your end goal in your allowance for doubtful accounts. In this case, we know that it has to be a credit balance because it's a contra account, right?
Right.
So in this case,
Okay.
my goal is to get to 25,000 on the credit side. Okay? So given the scenario here, in this case, I already am on the credit side by 5,000. So how many more do I need to get to 25? And that's why you subtract the two numbers, because in this case, I'm already 5,000. How many more do I need to get to 25,000? 20,000 more. Okay? And that's exactly what you're going to do here. So this is the balance sheet method. Okay? Any questions for just the balance sheet method?
No.
Okay. So then I'm going to talk about the income statement method, okay? Now, what's the difference between the balance sheet method and the income statement method, okay? Well, again, it's based off the income statement itself, right? When we create the income statement, right, all we care about is our total credit sales, okay? Nowhere on the income statement will you ever see accounts receivable or the allowance or doubtful accounts. So that's how the difference between is that when we're dealing with the income statement, we only see one thing and one thing only: total credit sales. Okay? No allowance or doubtful accounts, no accounts receivable. So, in context, when we take a look at this example here, we are looking only for two key features, right? Number one is the estimated amount. And then number two is the word total credit sales. Okay? Therefore, when we recognize this right here, right? Because we don't physically see the allowance for doubtful accounts appear on the income statement, therefore, we don't care about it. Okay? We don't care about it. We don't care if there's any kind of balance on that because all we know is we see the estimated amount and we see total credit sales. So, therefore, this is the easiest one because all we need to do is recognize what the estimated amount is. Because in this case, we don't care about the balance that there is in the allowance for doubtful accounts because it doesn't appear on the income statement. So our only assumption here is that whatever the estimated amount is, boom, that's exactly how much we're going to debit my bad debt expense for and credit my allowance for doubtful accounts for. Regardless, having an account balance in my balance sheet. I'm sorry, in my allowance for doubtful accounts. Okay? Any questions here?
On
No.
Okay?
the math at the, I'm sorry, on the math at the bottom, where it says 25,000 plus zero, where is that zero coming from again?
Because, so the zero, right? Because we recognize that when we're dealing with this method, the income statement method, there is nothing to add. There is nothing to subtract. Whereas the balance
Okay,
sheet
okay,
method,
correct.
there was something to add and there was something to subtract. So in this case, we're adding nothing because we don't care about whatever balance there is in the allowance for doubtful accounts because it doesn't appear on the income statement. So we don't care for it. Mm-hmm.
Yeah,
So we treat it as if it's zero.
thank you.
So there you go. Right?
So all these totals are being pulled over from the first one.
What's the first one?
The go back to, what's the name of it?
The
There,
balance
the
sheet.
income statement method.
Okay, the income statement method. Okay,
The
so
one, yeah, there. Go back to it, please.
this one,
No, the income the income statement, the other one.
The
You
next
were
one.
just there.
the balance sheet method.
One more. Did she pass it?
No, she said from the income statement sheet, balance sheet.
One more. Go one more. Right
Okay.
there. Stop.
Okay,
The
okay,
income
that's what.
statement
Okay,
method.
yes,
Okay, so these total the ones that you're going on, the next two, they're being pulled from this income statement method.
correct.
Each is okay.
Yes, because that's I wanted to show you so you the reason why they're called this is because the way that we pull this information out, right? When we create our financial statements, this is the numbers that we're pulling out from. That's where the estimated numbers are coming from.
Okay.
Okay.
All right.
So in this
Okay.
case, right?
I got a question before you
Yes.
move on. In this case, so your total credit sale is zero. That's why you don't add anything. So it could be a different circumstance, right?
In this case, right? Because okay, so the income statement, we don't see anywhere that says account receivable or the allowance for doubtful accounts.
No.
Okay, so therefore we don't care for it because it doesn't affect the journal whatsoever because that we don't care for it.
Okay.
So in this
So
case, right, my total credit sales, right? If you think about it, total credit sales is what you sold on an account. So
mhm.
it's another way of looking at accounts receivable, but in this case, right, we're treating it as if it's just my total credit sales. So in this case, right, out of my total $500,000 worth of total credit sales, we know that 25,000 of them are going to be uncollectible. I'm not going to receive that money. So this is the given circumstance where we're treating the same scenario but using different terminology to understand how we're going to write off my bad debt. Okay? Now, when we write off our bad debt, you can only choose one method because if you use both methods, you're going to double whammy yourself and write off bad debt twice. And that's not what we want. So there
Okay,
are
so this is where we would use one method or the other method. This is not,
correct.
we don't use both methods. Okay.
Correct.
All right. Wow.
Okay?
Okay.
Okay, the reason why we when we use gap allows us, okay, well, you have two options. You can either use the balance sheet method or you can use the income statement method. Okay? So when we're doing it like this, right? So we have to choose which one would make it easier for us. Now, obviously, we can tell
So
which one
it's
makes it
either,
easier.
so whichever one you use, that's the one that you stick with. You can't be flipping back and forth as you're going every day, right?
Correct.
It's either or. Okay.
Either or. And I'm showing you both
Okay.
because they both exist and they both are correct. Okay?
So how would you know what the company is using when you go into work?
They should always tell you. They should
Okay,
tell
they'll
you
tell you
exactly how to
exactly.
do it. Mm-hmm.
Right. Okay. All right. Got it.
Mm-hmm. But I'm telling you that both methods exist and they both are correct and they are both accepted by the by GAP. Okay. But okay, so then now one method deals with the allowance for doubtful accounts. You have to do some calculation. Where this one, we don't care about the allowance for doubtful accounts. We are the balance in it. We just care about what the total credit sales, what is the amount, and how much I'm going to write off. So in this case, right, my estimated amount was $25,000. So therefore, I'm just going to write off $25,000 because here the reason why we use the income statement is because we don't see the allowance for doubtful accounts. We don't see accounts receivable appear on the income statement. Okay.
All right, this sounds like a direct write-off method.
It sounds like it, but here's the key thing. Here's the key difference here is what accounts are we using? We're taking it out from the allowance for doubtful accounts. Okay.
Okay.
So if you want to go back real quick to see the difference between where the direct write-off method, right? You're directly taking it out from accounts receivable.
Yeah.
Okay? That's the huge difference here. Is you're not the tax accountant. This is for IRS and tax purposes only, where they're going to write it off automatically, right? So this is on their books. That's what they can do. But for us, we can't do that. We can't just claim a loss just because we can. Where in the IRS, right, they're doing it because they don't care about our business. They just care about how much you're writing off as a loss. But on our perspective, this is money that we're trying to collect from our customers. And we're going to try to collect them as much as we can by having an allowance for doubtful accounts where it's potential risk, but we're still able to collect it. That's the key difference here. Okay? Mm-hmm. All right? And once the allowance for doubtful accounts, if we have a balance in there, what if my customer turns around and starts to pay us again? Then we would have to reverse the transaction for us to be able to basically undo the write-off. Okay? And that's why you always will have a debit balance or a credit balance in your allowance for doubtful accounts, because you just don't know how your given situation with your customers are going to be. Okay? So there we go. All right, any questions in regards to this? So let's do one more example. Okay. For this example, right, I currently, the company estimates that 25,000 of a 500,000 total credit sales is to be uncollectible. Now there is currently a credit balance of $5,000 in the allowance for doubtful accounts. Journalize this transaction or journalize this adjustment. So in this case, right, we're still on the income statement method. Why? Because two things that we looked for is we have the estimated amount, 25,000. Second thing that determines which method we're using is going to be the word total credit sales. Once we see this, boom, instant, you should think about the income statement, because accounts receivable is not going to appear on it. So therefore, you will disregard about the balance that's currently in your allowance for doubtful accounts. And your only option here is you're going to take whatever the estimated amount is, and that's your answer. Okay? So once again, boom. You're going to add nothing or subtract nothing, because in this case, we don't care about what balance there is in the allowance for doubtful accounts. We only care about what the estimated amount is, and that's 25,000. So in this case, boom. You're just going to write off your bad debt from your allowance account for 25,000.
So that's the only difference between both methods. One you would use what's in the doubtful amount account,
Mm-hmm.
and the other one, it doesn't exist.
Exactly, correct.
Okay, all right.
So here's the chapter 10.1 review. Once again, we took a look at what happens when you allow your customers to owe you on an account, to owe you money, right? We see that during the period, so this is very important, during the period when a customer tells you they can't pay you back or for whatever the amount they owe, that's where you're going to create your allowance for doubtful accounts. So this is where you need to have this account before you can even do your bad debt expense, okay? So in this case, right, now we're saying, okay, my customer A told me they can't pay me, so because I know exactly who, I know exactly how much they owe me, and I know exactly when it happened. Therefore, I'm going to transfer the amount from my accounts receivable and place it into the allowance for doubtful accounts because it's potential bad debt. Okay? And
And this account is considered as a contra account?
contra account, correct.
Okay.
Okay? And then once again, when we reach the end of a given period and we're trying to, harass our customer telling us, hey, why aren't you giving me money back? I'm sending them bills left and right, charging them their late fees, whatever it is, right? And once you reach the end of a given period, that's when you come to a conclusion. Okay, I'm never going to get this money back from this customer. So therefore, I'm going to add that as part of my estimated amount. But I also have to consider that a bunch of other customers could potentially fault on my payment. So at the end of the given period is where you don't know who, you don't know when, and you don't know how much. So therefore, that's where you're going to make you're going to calculate an estimated amount, and that's where you're going to journalize it and write off this actual bad debt as a loss and take it out from your allowance for doubtful accounts. Okay?
Got it.
Mm-hmm. All right. So this step must come first, right? A person must owe you money. They must tell you, I can't pay you. So therefore, you transfer that amount into the allowance for doubtful accounts. And then at the end of the given period, if that person isn't still not paying you, then that's where you can write off and transfer that money from the allowance for doubtful accounts and convert it into a bad debt expense. And for
But you
sure.
don't really get rid of it because later on they can come and back and pay you.
Oh,
Right?
absolutely.
Is it like
That's
dormant?
absolutely. And that's
They just
exactly
stay dormant?
why that the bad debt is an estimated amount because you don't know who. For all we know, you're right. That person can come back and pay for us. So that's why it's an estimated amount. It's an overall assumption that all of the people could potentially fault you. You don't know who. Okay? So that is absolutely correct. Yes. This is just random people that you claim that, okay, well, 5% of them are not going to pay me back. Okay. We learned the difference between the two methods, which is the direct write-off method and the allowance method, which we said direct write-off method is for tax purposes only. Only tax accountants can do this. Okay, only the IRS can do this. Where regular accountants are going to be doing the allowance method, which we can choose from two different methods, right? Whether we use the balance sheet method or the income statement method, right? Balance sheet, there's a lot more to focus on, where the income statement, we only focus on total credit sales. Okay? Any questions for chapter 10.1?
No.
Okay? So now we're going to go over chapter 10.2 as well as 10.3. So, chapter 10.2, we're going to talk about time value of money. This is very, very important for a business because, once again, if you're going into business for the long run, you always have to assume that the dollar bill is not going to hold its value over time. Straightforward, right? $10 20 years ago was worth a lot. Now $10, fast forward 20 years later, it's worth almost nothing, right? $10 can easily be gone. So that's the idea here, is that time value of money is we're going to be assuming that things happen to the money and it causes either inflation, right? When the government produces too much money into the government and has it flowing out into there, or a recession where we have to pull back money, okay? So that's the idea here, is that when we're looking at time value of money, we need to take in consideration that the dollar value will not hold its value over time, especially just like what I've mentioned before. 20 years ago, a dollar was worth a lot. Nowadays, it's worth almost nothing. So that's the assumption here, is that we need to consider of inflation, recession, depression, whatever you want to call it, economic uplifting, whatever you want to call it, right? The bottom line here is that money changes value over time. Okay? Now, how do we make adjustments, or how do we consider these contributing factors, especially when we're looking at these examples here? So the reason why we would use time value of money is for two factors, right? Number one, if we decide to invest in some kind of bank bond securities, or we decide to take a loan out, right? Especially when we think about it, right? If your loan is 36 years, a house loan or something like that, right? You can imagine, obviously your interest rate's going to be low, but you can also assume that your dollar is not going to make its way up to whenever you pay, because it's going to change over time. So here's
Wait. You went out. I lost. You stopped. I didn't hear anything after you said 60.
60 what?
You were talking and you went out. You just came back in.
Okay. So going back, so
Is it just me or everybody else? Did you guys hear it blink out?
No.
okay.
Oh,
Okay.
I'm sorry. Maybe it's my internet out over here, but
Okay, that's
for
fine.
a couple of seconds I didn't hear anything. Okay.
All right. So in this case, okay, so we're considering two examples. It's going to be one for if you want to invest in bank bonds, or if you want to invest into a loan, or borrow money from the bank, or whatever it is. So okay, I was talking for example, right? If you take out a loan for your home, right? It's 36 years. Your dollar now and then 36 years later, it's not going to be the same. So obviously your interest rates is low, but we're talking about calculating amounts that does not take in inflation or dollar amounts, like it's not considered into the factor. In this case, we're making long projections to just make sure what our dollar value is today holds its value in the future. And on top of that, considering what possible drastic changes it can happen over time. So we're going to take a look at two types of interest. We're going to take a look at simple interest, and we're going to take a look at compound interest. Okay. Now, the most common one you will see here today is going to be compound interest, because of the idea that most commonly that you would more likely take out is going to be some form of loan, a credit card, any type of means to borrow money is going to be considered compound interest, right? Where a bank bond security, you're most likely probably not going to invest in that kind of idea, right? Or a retirement fund, right? Those only have simple interest because, again, your savings or whatever kind of mentality is that they're just taking your lump sum money and they're only going to charge interest once. Where compound interest is where you're going to be compounded, or you're going to be hit with interest multiple times. Okay, so we're going to take one at a time. So we're going to take a look at simple interest first. Now, here are a few things that you need to know. For a simple interest, you're going to have three variables. You're going to have a principal, which is your original investment. You're going to have your interest rate. So it's going to always be in terms of a percentage. And most commonly, when you look at the percentage, right behind it should say APR, or should say per month, or something like that. But most cases, most interests are APR, which is an annual percentage per rate, okay? Or annual percentage rate. That's what APR stands for. So that means this is how much percentage you're going to get charged per year, okay? So it's always going to be in terms of years. Where here, when we look at time is usually in terms of years, always, okay? But again, you can have short-term loans that are 6 months long. So then you're just going to have to convert that number into years. So that's half a year. So that's that one right there. Where compound interest is the same variables, except you have one more thing. You have how many number of times compounded, which is n, which is going to be the number of times you're going to be hit with interest. Okay, that's the difference. Okay, now once simple interest is you're going to get charged or calculated interest once. Compounded is multiple times. That's the difference there, okay? So let's take it down one at a time. Here, for simple interest, all you need to know is these two formulas, okay? How to calculate interest? Pretty straightforward, right? If you're a mnemonic device kind of person, think of it as pretty, right? PRT equals I, pretty. Okay? That's going to be your principal times your rate times your time. Okay, so once again, principal is your original investment times the rate, which is a percentage. So you have to convert that to decimals. And then time should be in terms of years. Okay, now to find your future value, what it's going to be now is going to be your principal plus your interest. Okay, so the formulas and the actual equations are right here. Okay, I am not going to have you memorize this because that's what the review sheets are for. I provided the review sheets that has all of these formulas in there. Okay, so for an example, let's take a look at this example here, right? For example, on this day, you decide to buy a bank bond from the bank that's worth $100,000, right? The interest rate is 6% and you can redeem this in 5 years, okay? So we're looking in context of buying a bank bond. You can't redeem your bank bond until it's matured. So past it's 5 years. So here my principal is 100,000. My rate is 6%. So we convert that into percentages, which is 0.06, and my year is in 5 years. So in this case, right, let's go ahead and solve for my interest. So I'm going to take my principal of 100,000, I'm going to multiply it by 0.06, and then I'm also going to multiply it by my time of 5 years. So in this case, right, 100,000 times 0.6 times 5 should give you a total of $30,000. Okay? So that's my interest that I'm going to collect on this bank bond. Now, how much it's going to be worth in 5 years is pretty straightforward, right? My future value is going to be my principal plus my interest. So therefore, in 5 years, if I want to check on the status of my bank bond, it's going to reflect that it should be $130,000. So therefore, when I redeem it, I'm redeeming $130,000 opposed to my original investment for $100,000. And that is simple interest. Any questions there?
No.
Okay, pretty straightforward, right? So now let's talk about compound interest. Now this one's going to be a little more complex because let's take a look at this formula. If I want to calculate the interest, right, the formula here is going to be my future value minus my principal. Okay, that makes sense, right? If I know how much I earned and I take out my original investment, that should determine how much interest I've collected. But let's take a look at my future value formula. My future value formula is going to be my principal times 1 plus my rate divided by the number times compounded, parentheses, exponented by the number of times compounded by my time in years. Okay? So in this case, right, you're not able to do this on a regular calculator. You can do this on Excel. Okay, and that's what I was supposed to teach you when we were supposed to do the lesson. But that's okay. I will teach it to you when we do the chapter 9 exercise. Okay, 9 and 10 exercise. So once again, here we are. My principle, right? Same exact scenario, except now I'm giving another key piece of information. I'm going to be compounded quarterly. Now, in terms of years, what does that mean when you translate it in English? How many times are you going to be compounded?
Every 3 months?
Every 3 months, so how many times a year?
4?
4, and that's correct because it's quarterly, right? So in this case, right, that's my numbers here. I have my original investment or my principal of $100,000. My rate is 6%, which I converted to decimal. The number times compounded. Since it's quarterly, that means every 3 months, or I get compounded 4 times a year. And then last but not least, my year is in terms of 5 years. So once again, when we are going to be punching this into Excel, okay, this is the exact order you need to have it, okay, because it's very crucial that you know this formula because this is what you're punching into Excel. You're going to equal, you're going to do your P, you're going to have your asterisk, open parentheses, 1 plus another open parentheses, your R, which is your rate. You're going to put your slash for division. You put your number of times compounded. Close the parentheses twice. Okay? And then you're going to do a caret, which is your Control Shift 6 on your keyboard. Okay? That's to show you that you're exponenting it, meaning you're timesing this it by itself, okay? And you're going to
So do you put in the FV?
FV?
Or you start with the equal, the F and the V? Do you start with the F and the V?
No.
Or do you start with the equal?
You start with the
You
equal.
start with the equal.
Correct. Okay? You start with the equal because that's how you create your formulas in Excel. You start with your equal signs. And then you punch this in, right? Caret is to exponent it, and you're going to do another open parentheses, n times t, closure parentheses. It's crucial that you do not forget how many parentheses you have. You should have a total of 6 parentheses in your formula. Because the way that Excel looks at a formulas is that if you don't have these parentheses, it's going to literally take 1 plus your R, which is 0.06, divide the whole thing by 4, which is not what we want. We want the rate to be divided by 4, not 1 plus the rate. So that's why it's very crucial that you have your parentheses because Excel is very precise. If you don't have those parentheses, you will get a really big number. Okay? So it's making sure that you want to say that you want to calculate this portion first and then calculate the second portion afterwards. So in this case, right, inner parentheses, then outer parentheses, okay? So you want to make sure that you're dividing the rate by the total number of compound, not 1 plus the rate, okay?
And you get the caret by, you said Alt Shift, clear
It's
Shift and a 6?
Shift and 6, the number 6 on top of your keyboard.
Okay, and that'll give you that little caret thing?
Correct.
Okay.
Shift 6, okay? So once you've done that, then it should look like this, right? Your future value, your formula should be your $100,000, the 100,000 times your 1 plus 0.6 divided by 4, caret 4 times 5. Now that's just without the whole parentheses, right? This is what it looks like plugging into the formula. Okay. And once you've done that, since this is a PowerPoint, I've already done the calculation for you, so this is what it should look like. So once you plug it in, you should get a total of 1, 3, 4, 6, 8, 5, and 50 cents. Okay. So in this case, right, compounding, right, gave you $4,000 more than you did for simple interest. Now, again, in context, that's not always true. Compound isn't going to always give you more money or vice versa, right? Because it just depends on what the scenario is. How many times it's going to be compounded is the most important thing there. Okay? So once again, boom. Then in order to find out how much interest they charged you, right, you're going to take your future value of the $134 and $685, and you're going to subtract your original investment to get the total interest of $34,000. Okay.
So this is the amount that you get if you compound the interest, what, $4,685.50 more if it's compounded than if you just than on the other like example.
Correct. Because in this
That,
case,
that
you're
which one?
you're calculating the interest
4 times a year.
4 times a year versus the other one was only once.
Once a year. Okay.
Mm-hmm. So once again, so this is just looking at a bank bond. Now, when we talk about credit cards, you are building on top of your principal over and over and over again. You're always going to have a new principal. If you ever seen a credit card, right? You may charge like $500. The bill's going to be like $525, right? Then if you don't pay it, then the next time they charge you interest, it's going to be based off of 525. So that's the difference between compound and simple, is that when you're looking at compound interest, it's building upon your balance every single time. But that's for credit cards. But when you're doing a bank bond, it's just one number.
Okay.
Mm-hmm. So now, how do we journalize this, right? Same thing here. We're gonna recognize that we bought a bank security, right? We originally invested $100,000 here, and we paid cash because you're paying the bank $100,000 for this bank security, right? But here, when we claim it, right, you're gonna journalize it exactly like this because, right, we're looking at this example where we bought a bank bond and it's redeemable in 5 years. Here, this is what we're going to do. We're going to say that we're going to claim that extra money. Excuse for that link right there. We're going to claim the money. We're going to claim that the original bank investment was for the $100,000, but we got interest income, right? We earned interest on this bank security right here, and we earned $34,000.
It wouldn't say compound. Because it just says interest income. It wouldn't say, or we automatically know that this is the compounded value.
Well, in this case, I'm just showing you the general idea of how to journalize it. So this can work for either or, compound interest or simple interest. In this case,
Simple.
in this case, this is compound interest because it's 34,685.50. That's what we calculated from compound interest.
Okay.
Okay, so I'm just continuing on to saying, well, this is how we journalize it in your books. Okay, you're going to separate that. You're going to redeem your bank bond, but you're going to recognize that your original bank bond security was for $100,000, and this is what the interest income was. This is what you earned in 5 years. Was you earned this much, or you collected this much money from investing. Okay. All right. How does interest get, what does it say, collected or compounded? So this is when we look at credit cards, right? So once again, I'm going to go briefly over this real quick, like real quick. So in this case, right, when we look at a credit card, for example, right, every time we build in a credit card or do a bank loan, right, first thing we got to do is we got to recognize what the bank loan is for when we originally had it for, right? Because when we borrow money, we're essentially getting money and we're owing a liability. Okay, but again, we also have to look at how much interest is going to be compounded, and how much you're going to be charged every time, right? Most bank loans, if not, they are compounded every month. Okay, some go as far as every day. So in this case, right, our assumption is that you're going to be compounded every single month, especially when you have to make those monthly payments. So in this case, right, I said that I borrowed $10,000, right? So here's my $10,000. And of course, when you first get your loan, your first initial thing is you're not going to get charged interest right away. You get charged interest the month after, right? Because right now I just borrowed the money. So therefore I get one free month to not collect any interest because I just borrowed the money. Okay. But when we decide to go ahead and take a look and when we make our payments, right, your statement should come in the mail and it tells you exactly how much is due, right? Usually you'll have what's called a minimum payment or you'll just have an amount. So in this case, my monthly payment is going to be $187.57. This is basically the amount that's right here is including your amount of interest. All right? If you've ever seen these ideas where you borrow money from the bank or you borrow money to pay for a house, right? Some credit banks, right, or debt collectors, they're going to make you pay the interest first. And then the remaining amount goes actually to your principal. So at the end of the day, when you're making a bank loan payment, right, you're always going to pay the interest off first. Okay? So in this case, right, so let's take a look. So if I borrowed $10,000 from the bank and my interest rate, once again, is 4.75%, and I'm doing it every month. So in this case, right, how I'm going to calculate this is my principal, right? So this is the amount that I owe is $10,000. Right? I'm going to calculate this number. So this rate right here is basically my 4.75% divided by 12 because I'm only making monthly payments, right? I'm only getting charged interest for that month. So that's where that number comes from. It's by dividing it by 12 months, right? And what I'm going to do is I'm going to multiply my principal times my rate to get my total interest for that month. So in this case, I'm going to be tacking on $39.58 because that's how much I agreed to being charged interest for the total of borrowing $10,000. Okay?
Wait. How did you get the rate?
It's the 4.75% because that's an annual percentage. I'm going to divide it by 12 because I'm making monthly payments. I'm getting compounded every single month.
Oh, okay.
So therefore, right, my calculation here is 0.03958, right? That's my interest rate per month.
And you divided it by the 475 times the $10,000.
No.
That's how.
No. That's for the whole year. That's for the whole year.
Okay.
I need to break down my rate because 4.75 is for the whole year. I need it in terms of months.
Oh, 12. Okay.
Yes, because I'm getting a monthly statement. I'm getting compounded every single month.
Okay.
So therefore, because my statement is only going to reflect to me what I got charged that month. It's not going to tell me what I got charged for the whole year.
APR is the key word.
APR, correct. It's an annual percentage per rate. But I'm not looking at an annual rate. I'm looking at how much they're going to charge me per month. So in this case, I'm going to take my 4.75% and divide it by 12 because I'm looking at my monthly percentage rate instead of an annual percentage rate. So therefore, once I do that, I'm going to multiply by my principal and I'm going to get charged $39.58 for the month of interest. Okay?
Okay, so you multiplied your your 39.58
No,
by what again?
you're
Your
multiplying the
your rate amount.
you're multiplying your rate times your original principal. So what did you borrow? I borrowed
Principal
$10,000.
10,000,
Right.
right?
And my
So you'll
total,
multiply that by your rate,
mhm,
and that's how you come up with the 39.58.
mhm.
That's not what I got. Maybe because I times it. 10,000 times the 0.003. Oops. Okay, I see. I got it now.
Okay.
And that's okay. So that's on a daily. I'm sorry, on a monthly basis.
Correct.
This is what you tell me.
Because usually when you pay your bills, right, you always have to pay your
Right,
loans based on a monthly basis. You pay every month.
right.
You don't pay at the end of the year. You definitely don't pay every day. You pay it usually typically at the end of the month. So
So
that's
your principal is the amount that you borrowed.
correct. That's my bank loan.
Okay.
Now, don't the 10,000 is not going to stay still because this is compound interest, right? This is where they get you. This is where they double tax you or double interest you. Okay? So here I have 10,000, right? I'm multiplying it by my rate of 0.003958, which is before the my annual percentage in terms of months, and I get a total of $39.58 worth of interest that is going to be tacked onto my bill. So therefore, my current balance will now reflect as $10,039.58. Okay? Now again, as we mentioned before, right, when you make a payment to any bank loan, your first priority is paying off the interest. And that is why no matter how many times you pay and you keep paying, your principal never seems to go down because you're paying off the interest first. Okay? So in this case, right, here's what I owe now. I owe $10,039.58. Then I'm going to go ahead and make my payment, right? My payment right here is already a calculated factor that already calculated including the tax, and I'm sorry, not the tax, the interest already. So they just broke down the principal plus the interest that they already calculated already ahead of time and divided it by the total monthly payments that you're supposed to make to get you a total of $187.57. So because I'm making this payment, right? Let's see what happens when I do that. So because the idea that you always are going to pay your interest first, you're going to recognize that you're going to make a payment to your bank loan, right? And you're going to recognize that you had to pay the interest first. Then obviously you wrote the check out, right? You made the payment. You made the payment for $187.57. Now, we've calculated what the interest was. It was for $39.58. So therefore, that's the first thing I'm going to pay is the interest first. And then whatever amount that I have remaining after I paid my interest is now going to go to my actual principal. So only $147.99 is actually going to my actual amount that I owe, my principal or my original amount that I owed from the bank.
Okay, got it.
So in this case, you're always gonna always pay interest first. Now, of course, this is based on just a simple bank loan, right? Some banks, they won't even calculate that. They're going to take this whole entire of 187 and just calculate it right off the interest automatically. Because once again, all of this is pre-calculated. So you definitely want to make sure that when you make a call to your bank, right? Tell them, I don't want to pay the interest. I want this check to pay towards the principal. But not many people know about that. They just pay whatever the minimum payment is and they assume that they're paying their loan off, but in reality, no. You're never paying your loan off. You're paying your interest off first. Go ahead, Nathan.
So you can tell them that because that's how it is with the house payments, right?
Yes,
That they say you pay
absolutely.
the principal and the interest first. So you could tell them that you don't want to pay the interest.
Yes. You could tell them, oh, well, but that's obviously, that's if you make multiple payments. You can't do it on your first payment. Absolutely not. They're not going to
No,
let
right.
that. They want their interest money back. They want their interest first. But let's say you're making double payments on your home loan to try to pay your loan off faster. Then you tell them, hey, my second check, I want you to put it to my actual principal. And yes, you can do that. Not many
Wow,
people know that.
that is good information.
Yes, not people know that. They just assume, oh, the bank should take care of it. No, the bank is out to get your money. That's what they're out for. All right. So, yes, Nathan, you had a question?
No, that was the thing that I was gonna say. You can do double payment for one of them for principal, the other one is for the minimum payment.
Absolutely correct. Yes, but not many people actually know that. Only financing people know that, and and that's why a lot of people who aren't financing majors, they don't know about that. They just think that the bank is doing them right. No, the bank is doing you really wrong.
Okay, so when you can't say it like you can only say it on the if you're making a double payment,
Correct.
but if you're making just the one payment, okay, no problem. But say you're making two and three payments, then you can say, hey, no, I want you to apply those next two payments and without the interest.
Correct, because you
That
already
makes
made you
sense.
because the minimum payment is essentially you're paying off your interest.
Wow, that's ooh.
Yes.
They be getting you, don't they? If you don't know, they will get you.
Mm-hmm.
Wow.
That's why credit card companies or bank loans or debt collector companies, that's why they make so much money because they don't educate the Americans because obviously why would you educate? Why would you tell people this? So then people could be smarter about it and not pay the interest. That's where they get the money from. Okay. So that's what happens here, right? But then let's take a look. So even though I made a payment to my interest, right? And my loan, now how much I'm going to be actually owing is now $9,852.01. But little did you know, if you don't pay your interest, you're gonna get interest on it twice as much because what happens is that it carries it over here. So if you didn't pay your interest, every time you get your monthly statement, you're gonna get double the interest. All right. If you ever heard of it, if you have taken a finance class, they call the double rule tool, the double rule method or something like that. Every time you owe money and you pay just the minimum, you're going they essentially they interest you twice as much.
Is that considered compound?
Not compound, no. That's just the reality, and that's where a lot of the bank credit card people, that's where they get the money from you, is because they think you're paying the principal, but you're not. You're only paying the interest. So that's where they double interest you on top of that. Because you're never paying your interest, so therefore you're always going to be interested every single month. So if you're never paying your interest, you're essentially paying them for all the interest that they're keeping collecting from you, and they keep charging you interest on top of that. So that's where they get the money. That's why they have so much money. That's why a lot of people use it because hey, why not? But because they're not educated in that and they don't know about it, every time they look at their statement, they're seeing that why isn't my principal going down? It's because you're paying your interest first, and every time you pay that interest off, you're going to be tacked on with another double interest again every single month. So, yeah, so that's how it works. That's how that interest is collected and that's how interest is um, calculated too. Okay? So every time you have a principal, right, your principal is going to change. But again, once again, because you paid the interest off in the very beginning of the month, and whatever remaining amount that you have, you're going to get double interest right here. And let's say you don't pay the minimum and you miss your payment. Why does your interest rate go up or your minimum payment goes up? Because now they're tacking on double the interest now because you failed to make your payment. So there's a lot of rules and a lot of things that credit card companies do to get their money from you. Okay? So that's why they always say, think twice before you open up a credit card or do a bank loan, right? You want to definitely look at these numbers. So that's why I'm teaching this to you. So then in the future, when you do open up a business, you want to consider all the factors that it takes for you to open up any kind of loan.
So those rewards, those rewards that you're supposedly getting when you spend more are not really rewards for you.
Mm-mm. And that's why, that's why they always tell you, you can't use your rewards to pay off your credit card. They want you to keep spending money. Because the more money you spend, the more money it goes into their pockets.
I have a question about that table. So, February you pay your principal was 10,000. You pay the minimum payment, which was 187.50,
Mm-hmm.
and your new balance is 98.5201.
Mm-hmm.
And then on top of that, you got charged the rate. So let's say that you next and March and April, then they're gonna yes, okay.
Mm-hmm. That's correct. So here, this is why when we look at bank loans and stuff, right, it's not one solid number. Every time you receive a bank statement, it tells you what your current balance is. So every time you see your current balance, if you don't make a payment, they're just going to take that current balance and just keep tacking interest on top of it, on top of it, on top of it. So in this case, you're getting double interest here because if you don't pay this off, right, you owe a total right now. So on February, right, if you didn't make that payment, you owe a total of $10,039.58, including the interest. And if you don't make that payment, you're going to get double interest because you're multiplying the interest rate once again to the current balance, including your interest. And that's what I mean by double interest. Okay, so here you're slowly paying your principal, but you're always going to be tacked on that interest every single month. Right?
Thank you.
Mm-hmm. Right, any other questions, comments, concerns? Okay. Let me see. If you can spare me maybe 20 minutes, because right now it's 11:45. I'm just gonna go quickly over bank reconciliation, okay? And then if you have any questions, we can answer them on Tuesday. Okay? So bank reconciliation. Bank reconciliation, right, is a common thing that businesses must do at all times, especially if you are running or when you have your business, right, you're constantly writing checks out, you're constantly charging your debit card, you're constantly making payments here and there, right? Now, of course, with the idea of writing checks out is that once you write the check out, it doesn't clear right away. Why? Because the person who's receiving that check is going to be responsible to place the money into their bank account. So the idea here about a bank reconciliation is that this is the best way to make sure that our bank account matches our checking account, okay? Now, of course, that's not the only thing that you can do. You can reconcile pretty much any account that you'd like, all right, that has some kind of running balance. So a perfect one would be a credit card, right? You can verify that when you charged your credit card, that you made these payments or you charged it for this, that you actually purchased this item, okay? So typical ones that you would most predominantly see would be a bank reconciliation. So once again, when we talked about checks, right? Just because we fill out the check, we cut the check and we send it out to our our vendor, right? It doesn't clear right away because again, checks take time, especially when we're shipping it out, right? If we're delivering the check, that can already take 2 to 3 days just to get to their place, right? And the ultimate goal here is that just because we wrote the check, but we don't see that money come out of our bank account, is because they could be holding on to it. So again, that's the idea why time stamping is also very important too when you write a check. But the idea here is that just because you cut your check, that doesn't mean it's taken out of your bank account immediately. And that's why we must do a bank reconciliation, because every time we write a check or every time we receive money or receive a check, right? Our bank account differences, right? If we're doing our account ledger, right? So we're going to be dealing with our own cash ledger to double check on and confirm how much money we have in our bank account at all times. Okay? So that's the key thing here. So here is going to be our check register. So just like what we've talked about before, if you're going to be cutting checks left and right, you want to make sure that you keep a register in your checkbook or somewhere in your books, so you can keep track of what check you wrote number out, who you wrote it to, and how much amount you actually sent the check out for. Because this is crucial, because when you double and check and confirm it with your bank statement, you can see which ones are pending, which ones have cleared, and which ones haven't gone through yet. Okay? So that's why it's very important that you have measures to make sure you're, doing your accounting accurately. Okay? So in this case, we're doing a bank reconciliation. So our very, very thing that we must have is that at the end of every given month, your bank releases a statement. This allows you to see where your money's at and where and what has happened throughout your course of that month, that given period, right? So at the end of every month, you are expected to do a bank reconciliation, okay? Because once again, right, there's a huge difference. If you wrote all these checks out and you said in your books that you don't have any money, but when you take a look at your checking account, right, and you see your bank statement and it says that, wow, only 5 checks out of 10 actually cleared. That means 1, it's being sent out to the person. 2, it takes time to process. And 3, that person's probably didn't even put it into their bank account yet. So therefore, they're holding onto your money. So therefore, here, the reason why we do our bank reconciliations is to double check to where our money is going. Okay? And then when we do our next statement, at least if we know that we've counted for it, instead of relying on our bank statement saying, oh, wow, I have so much money left, and forgetting about the other 5 checks that you wrote, can put you in, could make you very deep in trouble, right? Because therefore, you didn't do your accounting very good and you forgot that you wrote these checks out just because you assume that it's been cleared out. That's not how banks checks work. That it works in 2 ways, right? You need someone to have the recipient on the other side and however your bank reports it, okay? So once again, you're going to have a monthly bank statement. So usually happens at the end of every month, okay? Gives you your total balance, right? Okay? And then you're going to have your own cash ledger. Cash ledger, checking ledger, whatever you want to call it. This is your means of you keeping track in your own personal book, right? Because every check that you write, you're going to make sure that you have enough money in your bank account to even write that check. So that's why it's important that we use our ledgers for that very reason, okay? And of course, checking is going to be the most important ledger because once again, you need to know how much money you have in your bank at all times. Okay? So here, that's what you need. You need your bank statement and you need your cash ledger, checking ledger, whatever you want to call it, and you need your check register too. Okay? So how we're going to be taking a look at a bank reconciliation is that we're going to consider two parts, right? You can consider what the bank sees and you're going to consider what you see, right? Now, of course, when you're dealing with the bank, right, and you're using the bank account, there's a lot of things that you don't know that the bank charges you, right? And one of them is going to be any service charges or any fees. So especially when you write a faulty check, boom, you get hit with an NSF fee, right? A non-sufficient funds fee, right? Or if you overdraft or you pull too much money out of your bank account, right? You're going to get hit automatically an overprotection draft fee, right? Automatically. And in your books, you're not going to record that because you don't know about that until you find out on your bank statement. Okay? So that's why it's very, very, very crucial that you keep a good track of your bank account and that you always have access to your bank account to make sure that what has cleared and what has not cleared. Okay? So that's the idea here is that we're going to be taking a look. Okay, what does the bank know that I don't know? So in this case, the bank knows that they charged us for service, for bank services, right? If we order checks from them, they charged us money directly. And other things like NSF checks, overdraft protection fees, any type of fees, okay? They're going to know that, but you're not, okay? Now, what does the bank know that you don't know? That you know, that the bank doesn't know, is that you have cash on hand. You have written all these checks. But does the bank know that? No, the bank only knows it as soon as you send it out and the other person cashes it out. That's all the bank knows. So the bank doesn't know that you wrote all these checks out, that you deposited all these monies. Okay? So that's what you have to consider when we're doing a bank reconciliation is we're trying to make our bank statement and our cash ledger kind of like communicate with each other so then you know at the end of the day how much cash you actually have in your bank account. Okay? So let's go ahead and start on the bank side. So usually that's always common, right? So when we understand the bank side, right, as we mentioned before, they don't know how many cash deposits I have made, nor how many checks I wrote. So on the bank side, we have to consider this. We're going to start with the ending balance in both accounts, right? So in my bank account, right, I'm going to find that easily on my bank statement, right? My ending balance is $9,446.40, right? That's the first thing you got to put in there, okay? Second thing I'm going to consider is I need to add any deposits that are in transit. So oftentimes, right, when you go to a bank and you deposit a huge lump sum money, it's not going to go right into your checking account right away, right? If you decide to go to the bank and deposit $10,000, maybe $5,000 are going to show up right away, or even $1,000 are going to show up right away. But it takes time to process because first off, the bank's got to run some background check to see where this money came from because if you're coming to the bank and you're dumping $10,000, that's kind of suspicious, right? Where did you get this money from? So that's exactly that's why it takes so long to process because they need to see if this money is legit, that you didn't steal this money or that this money hasn't been reported anywhere. Because, money has that serial number on every single dollar bill. They're going to run and scan that. So that's why it takes forever or it takes 2 to 3 days to process the money into your bank account. Okay? So that's the idea here is that if you deposited money, usually, once again, banks close on the weekend, right? Friday at 5 o'clock, they're done doing business. So if you decided to go to the bank and, use the ATM to deposit your money, maybe like $100 or something like that, it will not clear until Monday morning, right? Because the bank closes. They don't do work on the weekends. Okay? They're closed out, especially for the ATMs. They close out for the weekend, so any deposit that you make on the weekend will not appear until they open their office on Monday morning at 7 a.m. Okay? So that's the idea where deposits and transfers come in. So if you're depositing money, right, and it doesn't show up on your bank account, that's how you know. So how do we know that? Well, obviously you can have a cash ledger, and you're going to make a note of all the cash that you deposited into the bank. So in this case, right, I had deposit slips. So I have deposit 44, 21, 22, 23, 24, 25, 26, 27, and that's it, right? I made 7 deposits. Let's take a look at how many of those deposits actually cleared in my bank. Obviously, some of them go through the same day, some of them don't. So in this case, right, my money has gone through. I have 21, 22, 23, 24, 25, 26. Oh, wait, I'm missing one deposit because look what happened. I end up depositing it on the end of the month. That could have been a weekend. That could be just one of those days that they just don't work. Holiday, etc., etc. So in this case, because I deposited on the 30th, it's going to take 2 to 3 days to transfer into the bank account. So in this case, my bank does not appear on my May statement. So therefore, that's considered deposits in transit. So in this case, I have pending $254.52. Okay. Now I got to look at my outstanding checks. So on my books, right, I wrote all these checks out. Now, once again, as I've mentioned before, right, it only appears on your bank account as soon as the recipient of the person that you wrote the check out to cashes it out into their bank account. Now, if they can hold it, right, we all know checks, right, they have a 6-month holding period, meaning that person can hold onto that check as long as they want and decide to deposit it until the very last of the day of the 6th month, and then they can cash it out. So therefore, we need to make sure that whatever cash that actually went out, we need to make sure that the bank knows that we still have pending checks that we wrote out. So in this case, right, we wrote check number 125, 26, 27, 28, 29, 30, 31, 32, 33. Let's see which checks have actually cleared. Only check 25, 26, 27, 28, 29, 31, and that's it. So therefore, we're missing check number 130, 132, and 133. So once again, because these two, right, could be possible factors, right? You might have just cut the check and you shipped it out. They haven't received it yet. Other ones could be they could be holding on till maybe the end of the week to gather all the checks and then deposit it all at once. Many businesses have different, policies on that. So in this case, right, we have 3 outstanding checks that we have written out that has not cleared through the bank yet. So therefore, we need to place it here, okay? And how we calculate this is that, okay, we have our ending balance, right, in our bank account. This is what my bank statement reflects. I'm going to add money because this is money that is going to be transferred into the bank account. We're going to subtract our outstanding checks because, again, we wrote these checks. This is potential money that's going to be taken out from my bank account. Okay? So here we started with $9,446. We're going to add $254, and we're going to subtract out $2,216, and we now get a total here of $7,483.96. That's my bank account right there. Okay? Now that I've resolved my bank side, I now have to resolve my cash side because what do I know? What do I not know that the bank knows? So in this case, right, we can, if we're using EFTs, we can tell the bank, hey, charge additional convenience charge to my customers. So that's going to be collected interest that you can collect. That is your money. So that's going to be something that you are going to be adding into your your cash side, okay? Because obviously they're going to transfer it to your bank account automatically without letting you know. Same thing here. They're also going to charge you for any fees that you have with them. So for example, right, our first one is going to be looking at our cash ledger, right? We got to start with our ending balance. Here in my ledger account, I think that I should have a total of $7,338.96. Okay? So there's the difference here. My beginning or my ending balance are going to be different, right? I show that I have $7,000 left, but on my bank side, I show that I have $9,000 left, right? That's because of the $2,000 that we said that we wrote, that we sent out the checks for, haven't cleared yet, okay? Now the interest that's collected, right? Again, if you're using EFT, you can tell the bank, hey, charge my customers interest on top of those payments, like a convenience charge, right? So therefore, when I look on my bank statement, there should be a small section that allows you to see the interest or the ACH. ACH stands for the Auto Clearing House. So this is where if you charge your customers, right, especially for finance charges, right, if they decide to pay online, you charge interest on top of that, right? Auto Clearing House is where it's directly correlated to your EFT transfers, right? If they decide to send you money, right, to pay off their bill, that's the convenience charge that you tell your customers that you want to charge them for. Okay? So this is money that you're going to be collecting. So therefore, I have $15 and $215. So this is money that I earned because of the rules that I said out to my bank. Okay? So this is money that I earned on top of that. Okay? And then I'm gonna take a look at what service charges or any NSF fees, right? Or if I wrote a check and it bounced, right? They're gonna charge me money for that. So in this case, I have service charges, right? I use the bank to take care of my checks, payroll checks, anything like that, right? That's gonna be considered $50 service charge. Okay? And here, the return check fee. Once again, I wrote a bad check and I guess it bounced. So they charged me $35 because the check bounced. Okay. So once again, your fees can be infinite, right? It could be for any reason that you do something wrong with the bank. Okay. So therefore, I'm going to place that right here. So how this works when I calculate it is that I'm going to start with my ending balance. I'm going to add the interest that I've earned, right? Things that I charge my customers for, okay? And then I'm going to subtract any fees that the bank has charged me because once again, the bank knows that. They already automatically took it out my checking account without letting me know. I only know because I looked at my bank statement. So here, if I started out with $7,000, right? I'm going to add the $230 of interest that I've collected, and I'm going to subtract out my $85 of my fees that I encountered. So therefore, I should get a total of $7,483.96. And here's the catch. Your bank must match your cash ledger at the end of the given period. So in this case, the end of the month, if these numbers do not match, you need to find where that extra discrepancy is. So in this case, my balance, my adjusted ending balance matches on my bank and my cash side. So therefore, this number right here is what I'm going to carry on for my next month of transactions. Okay? I adjusted that, okay? So once again, that's how a bank reconciliation is done. Okay? You're going to compare your books to the bank's, and you're going to see which sections are overstated or understated. Okay? And you're going to compute this. So at the end of the month, when you reconcile your bank, you figured out what they charged you, you figured out what checks haven't cleared, you figured out what interest you've collected versus the deposits that haven't cleared yet, then you're going to get this number. Once you get this number, then you completed your bank reconciliation. The goal is that they have to match at the end of the month. Okay? Any questions there?
I'm just thinking about if I did that with my bank card, with my credit card. I
Mm-hmm.
mean, I'm swiping and swinging that thing like practically every other day.
Exactly. And they make it so much more easier to be able for you to keep track of it because once again, everything is in the palm of our hands, right? The vast majority of using online banking and mobile apps is almost the greatest thing, right? Because you can charge your bank account and it's going to show up on that application automatically right away. The minute you charge it, it's going to show up on your app. So that's the great thing about having online banking. Right? Oh, any other
Oh,
questions?
so this you can keep up better with the. Well, I guess yeah, with the online. I need to do better. Looking at this, I really need to do better with
Okay.
my spending habits.
Yes, and that's why this is not only just a business practice, it could be a personal practice too. Especially if you're the kind of person that writes checks or has a debit card and you're swiping, 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 and you don't even know how much you have in your bank account. You keep swiping, swiping, swiping. It's definitely, you should definitely consider this for a personal use as well to make sure that the many times that you charge your credit card or your debit card, you're making sure that you are making sure that you have enough bank, money in your bank account before you swipe. So that's why it's also very good to keep track of it. And same thing with online transactions, right? Like I don't know, Amazon, if you ever tried Amazon, you think they're going to charge your bank account right away. Sometimes they don't. Sometimes if they don't ship the item out like until 2 weeks later, they won't charge you until they get close to the shipping date. So you're thinking in your head, oh my God, I have so much money. But in reality, no. You purchase things online and you just waiting for them to charge you. So that's one good example of how you can use a bank reconciliation for personal life too. Okay? So once again, how do we make our bank account match our ledger account? You simply are going to do this, right? Because in this case, right, the bank already automatically charged you without even letting you know. They already took the money out. They already charged the money out from your checking account automatically. So what you're going to do in your books now is that now you're going to do this. You're going to debit any interest that you've collected, that you've earned from your customers, and you're going to credit your checking account for any fees that you had to pay. Okay? And that's it. So thank you for your extra couple minutes of time. So once again, we took a look at bank reconciliation and we took a look at time value of money, right? Bank reconciliation, because for this class and because for the test, I can test you on almost anything that you can be. I can test you on many discrepancies. For this one, I only want you to know your do's and your ifs. Okay? So on the bank side, you're always going to do. You're going to have your bank. On your bank side, you're going to have your deposits in transit, and you're going to always have your outstanding checks. Okay? Where on the cash side, you're always going to have your ifs. Any interest, so ACH including, and any fees that you have to pay. And at the end of the day, your bank reconciliation, your adjusted balances must match at the end of your bank reconciliation. So once again, I'm only going to have you focus on your do's and your ifs. So your banks, you're only focusing on your do's, your cash side, or on our side, the book side, you're looking at your ifs. Okay. Once again, here we took a look at time value of money where we took a look at what interest does. So again, we have simple interest and compound interest. Here I put the formulas here so you know what they are. Now, once again, I've also attached here the Excel formula. So when you do compound interest or when you do compute it and you use your Excel for this, because you can't do it on a regular calculator. You must have the fancy, expensive, scientific calculator, right? In order to do this. But if you use Excel, right, you guys should have Excel. It's free for you guys. So therefore, this is the computation that you need to use to solve for your compound interest. Okay. So again, once again, thank you for the extra spare minute of time. So any questions, I will have them answered